Imagine you're standing in front of a massive, reinforced glass wall. On the other side of that wall is everything you've been promised: Bitcoin at $150,000, the end of the debt-based fiat system, and the kind of generational wealth that changes your last name forever. You can see it, you can almost touch it. The ETFs are here, Wall Street is buying, the supply is shrinking. Every single fundamental indicator is screaming that the price should be in the stratosphere. But instead, you're watching the chart bounce off an invisible ceiling like a bird hitting a window. You bought in at 85,000, maybe 95,000, or even right at the psychological barrier of $100,000. And now you're asking yourself the question that keeps every retail investor awake at night. Why isn't it moving? Why, despite all the good news, does it feel like something is holding the price back by its throat? What if I told you that you aren't imagining it? What if the invisible ceiling isn't a conspiracy theory, but a perfectly legal, highly sophisticated financial mechanism used by the world's most powerful banks to suppress assets while they fill their own pockets? We're talking about a strategy that's been used for centuries, from the collapse of the Ottoman Empire to the 1982 Mexican debt crisis, and now it's being deployed against the most unsuppressible asset in history. This is the story of the debt spiral, a legal trap that involves convertible bonds, $16 billion in obligations, and the man who currently holds the keys to the kingdom, Michael Saylor. By the end of this video, you will understand exactly how the MicroStrategy Trap works, why the banks want you to stay frustrated, and most importantly, why the next few months might be the most dangerous and profitable period in Bitcoin's history. I'm Dave, and you're watching Dave Invest Smart. Before we peel back the curtain on this financial thriller, do me a favor. Hit that subscribe button and turn on the notification bell. We're building a community of investors who look past the headlines to see the actual gears of the machine. And I don't want you to miss a single beat as this market volatility ramps up. To understand why Bitcoin is stuck today, we have to look back at how the big players handle assets they can't control. Historically, when a bank or a government wants to acquire something valuable at a discount, they don't just buy it on the open market. That would drive the price up and make it too expensive for them. Instead, they use financial pressure without financial crime. They create a structure of debt that forces the asset to behave in a specific way. Think back to the early 2000s and the era of death spiral financing. Small companies would take out loans that were convertible into shares. If the company couldn't pay the debt, the lender would get shares at a discount. The lender would then immediately short the stock, driving the price down, which meant they got even more shares when the next debt payment was due. It was a self-fulfilling prophecy of destruction. Now you might be thinking, Dave, Bitcoin isn't a small company. You can't just death spiral Bitcoin. And you're right, you can't kill Bitcoin, but you can ceiling it. Enter the MicroStrategy flywheel. Michael Saylor has been hailed as a genius, and for good reason. He has turned a legacy software company into the world's largest corporate Bitcoin vault. But how is he buying all that Bitcoin? He isn't just using company profits. He is issuing billions of dollars in convertible senior notes. To the average person, this sounds like boring accounting. To a Wall Street shark, it's the ultimate arbitrage opportunity. Here is the MicroStrategy Trap in plain English. When MicroStrategy issues a convertible bond, they are basically telling big banks and institutional investors, give us billions of dollars today so we can buy Bitcoin. In return, we will give you a small interest payment, and in a few years you have the option to convert that debt into MicroStrategy stock at a specific price. Now, imagine you are a massive hedge fund. You give Saylor $500 million. You now have a long position on his debt. But because you are a sophisticated predator, you don't just sit on your hands and wait for 5 years. You want to lock in a profit today, so you engage in delta hedging. You short the underlying asset, Bitcoin, against your position in the debt. Because the MicroStrategy stock is essentially a proxy for Bitcoin, these institutions are creating a massive amount of paper selling pressure every time Saylor announces a new debt offering to buy more spot Bitcoin. This creates a bizarre paradox. Saylor goes out and buys $2 billion worth of actual physical Bitcoin off the market. That should be bullish, right? But at the very same time, the institutions that lent him the money are opening up billions of dollars in short positions or paper hedges to protect their investment. The result? A net zero movement in price. The spot demand is being neutralized by paper supply. This is how you create a $16 billion debt obligation that acts as an artificial ceiling. But why would the banks do this? Why not just let Bitcoin go to $200,000 and make money on the way up? To answer that, we have to look at the psychology of the discount hunter. Banks don't like buying at the top. They miss the boat at 20,000, 40,000, and 60,000. They need time to accumulate. By using the debt spiral logic, they can keep the price suppressed in a range, say between 85,000 and 104,000, for months. This range-bound trading frustrates retail investors like you. You see the ETFs, you see the news, but the price doesn't move. Eventually, you get bored. You get shaken out. You sell your Bitcoin to rotate into some shiny new altcoin or just go back to cash because you think the bull run is over. And who is standing there with their hands open, ready to catch your cheap Bitcoin? The very same banks that are currently hedging against Saylor's debt. This isn't just a theory, it's a playbook. Look at what happened to Mexico in 1982. They had massive amounts of oil, a valuable asset. They took on massive amounts of dollar-denominated debt. When the interest rates rose and the debt became unpayable, the lenders didn't want the money, they wanted the oil. They forced Mexico to sell their resources at a massive discount to service the debt. In the modern version, Bitcoin is the oil, the convertible bonds are the debt, and the discount is the sideways price action that makes you want to quit. Let's talk about the risk of the catastrophic flywheel. Michael Saylor is betting everything on the idea that Bitcoin will always go up over a long enough time horizon. And historically he's been right. But debt has a ticking clock element. If Bitcoin were to face a massive, unforeseen black swan event, a regulatory crackdown or a global liquidity crisis, and the price dropped significantly, the debt spiral could turn into a death spiral. If the value of the Bitcoin on MicroStrategy's balance sheet falls below a certain level, the institutions holding the debt might start dumping their shares and aggressively shorting Bitcoin to cover their losses. This would create a cascade of liquidations that could flash crash the market. Now, I'm not saying this to scare you. I'm telling you this so you understand the stakes of the game. We are currently in a high-stakes poker match between the HODLERs and the hedgers. The hedgers have the debt on their side, but the HODLERs have the math. There is only so much Bitcoin in existence. Eventually, the paper supply created by these debt hedges won't be enough to hold back the spot demand from the rest of the world. When that wall finally breaks, when the short squeeze of the century happens, the move from 100,000 to 150,000 won't take months, it will take days. But until then, you have to survive the financial pressure. You have to recognize that the price action making no sense is actually a sign that the system is working exactly as intended. It is designed to be confusing. It is designed to be exhausting. If it were easy to hold Bitcoin to $1 million, everyone would be a billionaire. The market pays you for your ability to withstand the psychological warfare of the debt spiral. So what are the action steps for a long-term holder facing this volatility? First, stop looking at the 1-minute charts. The banks want you focused on the noise. If you're looking at the macro view, the debt spiral is just a tiny blip on a much larger upward curve. Second, understand the Saylor premium. When you buy MSTR stock, you are buying Bitcoin with a layer of debt attached to it. It has higher rewards but much higher risks. If you want the pure play, stick to the underlying asset. Third, and most importantly, don't use leverage yourself. The banks use debt because they have the capital to hedge it. When a retail investor uses leverage, they are just providing liquidity for the banks to eat. If you hold your own keys and have no debt, the debt spiral can't touch you. You can sit behind that glass wall as long as it takes for it to shatter. We are witnessing the institutionalization of Bitcoin in real time. This isn't the Wild West anymore. This is the era of structured finance. The banks are here, the debt is here, and the games have become much more complex. But the goal remains the same: sound money in an unsound world. If you found this deep dive helpful, please share it with one friend who is currently frustrated with Bitcoin's price action. We need to spread the word about how these legal suppression tactics work so more people can stay in the game. And if you haven't already, please hit that subscribe button. I'm Dave, and this is Dave Invests Smart. I'll be right here with you, tracking every move of the machine until that glass wall finally comes down. Stay smart, stay patient, and I'll see you in the next one.